Okay, so hello and welcome back to the sixth of my eight episodes regarding trying to get my colleagues and my peers a bit more financially educated, trying to explain the instruments or means by which they can either trade or invest based on their choice completely. Just trying to get them to understand what's out there and what other people may actually be using as well. Which may actually influence or impact your own investments directly or indirectly. So the usual disclaimers before we start. This is not financial advice. It's only my opinions. In fact, there might actually be some holes in this opinions as well. It's just what I've learned over the past year or 18 months, trying to compress it into 30-40 minute chunks so that you can digest what's happening out there. It's again only my opinions out there is for educational purposes only. I may mention tickers, I may mention brokers, I may mention a lot of specific things. I don't mean to say that's the best thing to invest in. It's just the easiest example that comes to my mind at that moment. There's no script back here. It's just I know what I want to say, and I make it up as I go along. Finally, content is being recorded. There's actually quite a lot to cover today, so I'm just going to jump right into it. So let's go to from the current slide. Yeah, I hope you can see my screen this time. It is recording, sharing, life's good. So we're going to talk about derivatives today, guys. I've been so pumped about this because this is like one of the most advanced and least known instruments out there. Everybody knows about funds, mutual funds. Your granddad probably knows what mutual funds are. ETFs are a bit new, so maybe your pops might know what ETFs are. You definitely should know what ETFs are by now. Finally, you've got derivatives, and this is so lucrative, and people just try to shy away. Apart from a select few who actually try to get involved more actively, and obviously some are more accessible than the others. I think in this particular order, CFDs, options, futures, swaps. That's the particular order in terms of ease of access to a retail UK investor. In America, it would be slightly different, I imagine. But I'm from the UK. I'm in the UK. That's what I'm speaking for. So, before we actually speak about derivatives, we need to cover an important topic: leverage. So, leverage it comes from the common term wherein you lever a small capital to try to get a larger output or a larger movement later on. In most cases, leverage is trying to use money that you don't actually have. It's not cash; it's a form of debt. And this is often to purchase or open positions for which you don't have your cash in your account for. So when I say positions, I mean I don't know where the word positions come from or where it derives from, but just think of it wherein you try to buy a stock. You have a position open in that stock, so to speak, and when you sell that particular stock, you've closed your position. You are taking a stance. You're making an assumption stock will go up or go down, and you're making a stand. Hence the term position. That's my understanding. I'm not going to go into the depths of it. You can take from it what you wish. It can be an excellent tool if you know what you're doing and have a strategy to be statistically slash consistently profitable. Now, the stock market is literally a 50-50 game. If I ask 10 people what Apple will do tomorrow, about half of them, maybe 6 to 4, maybe 7 to 3, will say it goes up, and the other portion of it would say it goes down. And if I go to a larger audience, 100 people, then the odds become closer and closer to 50-50. And that's what the stock market is likely to be on a short term basis, on a daily, weekly, monthly, even annual basis. It's only when you move into decades or several years and on end wherein the odds start to play in your favor, wherein the market or the stock market always goes up due to variable reasons or understanding. It's typically money lent to you by your broker based on their risk tolerance of you. So that if you're a new customer to them, they probably lend you very little money, maybe even none, depending on the positions, because the stock market, again, while it's a 50-50 game, there's also a probabilistic play on play in the background. So certain strategies and certain trades would have better probabilities of you making a profit, as in they think the broker will know or think that you know what you're doing and would tend to lend more to you. So if the broker thinks you have a relatively winning position on your hands, they may even go as far as lending you a little more, or costing you a little less, so to speak. They won't actually lend you more money. They'll just reduce the amount of leverage. They will just increase the amount of leverage by reducing the amount of capital that you're using, if that makes sense. Where does this come in handy? So, just a complete external example is if you have a very strong hunch about a horse race, and you've only got like 2 grand in your account, but you're like 100% sure, you're like 90% sure that that particular horse out of 8, 10, 15 horses is going to win the race for whatever reason you believe in. um, you could use that 2 grand, go to a loan shark, keep that as collateral, not the cash. If you've got the 2 grand in terms of gold bars or whatever, you can go to a loan shark, you can get 10 grand for that collateral, for example, uh, and then leverage and then use that 10 grand to bet on the horse that you just picked. What you've done is you just leveraged your gold bars worth 2 grand to get a loan, if you will, of about 10 grand, which you will promptly repay after you've hopefully won, or if you lost, then you better hide. Anyways, that's where leverage comes in handy. It tries to utilize money you don't have in order to try to get a bigger exposure, to make bigger profits, or bigger losses consequently, based on your financial position. And that's basically what's happening in some aspects of the market as well. I think today is the 31st of March, and you probably would have heard that some Chinese stocks, as well as stocks like Discovery and Viacom, which is the US media companies, have done very poorly on Friday and Monday of this week, of the past week, because a hedge fund which was actually leveraged, or levered 5 to 6 times their capital. And once a catalyst happened, I think it was last Friday, wherein which didn't work against their favor, their losses were now greater than 100%. They're looking at a potential loss of 500% of their positions. Of course, it didn't go to minus 500%, but that hedge fund has now pretty much gone bankrupt. They're pretty much in debt, as they got a bit too cheeky and took on a bit too much risk. Right. The second concept I need to put across to people is the idea of selling something you don't own, right? Most people just go and they buy stocks, so buying a stock is buying to open a position in that stock. You are going long in that stock, you are bullish. Again, I mentioned bullish a couple of weeks ago. Bullish is when you assume the market is going to go up, or the market going up or your stock going up is a good thing for you. That's bullish. The opposite of which is bearish, wherein the stock going down would be beneficial to you, right? So going long on a trade is typically a bullish move. So you are buying a stock, uh, hence going long, and hoping for capital appreciation of that stock so that you can make some money, hence the term bullish. So when you buy a stock, you are buying to open a position in that underlying, and consequently to get your money back out from shares. So when you buy a stock, you're converting your cash to a share or a stock, for example. I'm going to use them interchangeably, so just deal with it. Uh, and when you sell that stock, you are then converting your shares back into cash. So you're selling to close your open position. And therefore, you are now short. They both cancel each other out. So you're net neutral. And hopefully, you've got some excess cash from the movement from the actions you just performed. Leverage and derivatives allow you to sell a stock that you no longer that you do not own, and is often lent to you by a broker. So you're selling to open a position because you don't own the stock. You're selling the stock in the open market, and therefore you are assuming the stock will go down in value, and that's what will make you profit. And hopefully the stock goes down or in your favor. So you're going to buy the stock back from the market to cover or close your open position. So you're going to go back long again. And again, the net effect would be hopefully an increase in your bank, in your brokerage balance, in your cash balance, and you'd have a net zero shares movement again. As buying and selling shares is the most common form of trading, the world by default, by investing in funds, by investing in ETFs, by investing in independent stocks, they're net long. They buy and hold Apple, they buy and hold Coca-Cola, or they buy and hold SPY or ARK or whatever it is for the rest of their lives, for years, decades, whatever. And that's what most people do. So that's why the stock market tends to just go up over time, as people just buy and they hodl for life, so to speak. So we've got four options available to us when it comes to an underlying. Either it be stock or the contracts that I'm about to discuss in a bit. And derivatives, just to clarify, derive or have their name coming from the common math term, wherein they're deriving their value based on the underlying. So they have a relationship to what they're derived on, hence the term derivatives. And they're basically, most derivatives are essentially contracts. That's how you're able to sell something you no longer have. You, by selling or shorting a stock, you are opening a contract. Well, in the case of shorting a stock, you're actually borrowing a stock from from your broker, and selling it in the market. Whereas most other derivatives are somewhat contracts. I just don't want you to confuse dealing in stocks directly with the derivatives of these stocks that are basically contracts. Right. So the first thing and the most easily accessible derivative out there are leveraged ETFs. Leveraged ETFs are actually available to some people in their ISAs. However, the invest side or the general investment account tend to have a much wider variety. This is basically treated as a normal ETF on the market, but are inherently leveraged by the issuer or the provider of the ETF to try to attain a certain target. So they will have the name as in, three times Tesla, three times S&P, minus three times Netflix, or minus two times DAX. DAX is the code for the German market. What's happening here is a 1% or a 1 point move in Tesla, the underlying, would then result in a 3% or point move in your position. You would make three times whatever the movement Tesla is making. So if the Tesla goes down by 1%, you lose 3%. If Tesla goes down 33% in a day, you will be down 99% on your position. Hopefully, by which point you've already sold and moved on. But that's something that can entirely happen. The same way, if Tesla shoots up, in this case, 33%, you basically doubled your account. You're 99% on top of whatever your capital or investment was. I like to think that leverage would also include minus one or 1x stock. So 1x stock is a standard buying and selling, but leveraged ETFs would also include minus one times your, so you're shorting one times your underlying. The way the issuer has to achieve these targets is by using complex instruments, which we're actually going to discuss in a few minutes. It's going to be, it could be a mixture, it could be one particular one, but the ETF issuer would publish their their documents. If you go to their website, have a look at all their available documents. They'll tell you how they're achieving the targets that they're doing. It's great for short-term plays if you want to have a go at it. It's mostly for intraday or even weekly trades. You hold for a week, hold for like maybe 2 weeks at most. But over the long term, they would almost always fall under their inherent name because of the fees that your ETF provider needs to pay to maintain the contracts to ensure that they can get the three times the return. So of course, to hold these contracts, they're paying a premium or a fee, which they will consequently charge you for. So maybe in a day, the performance will be three times Tesla, for example, but over a week, it could be 2.9 times. Over a month, it could be 2.6 times. Over a year, it could be, two times, or even as low as 1.2 times. So you've increased your risk by three times, but the potential profit over a year is only 1.1 or 1.5 times. So the risk reward ratio over the long term just deteriorates. I've actually got live examples. So I've actually prepared. I come prepared this time. I've got my demo account open on my Trading 212. Let's go to the invest account. We'll talk about CFDs next, which is why the tab was open. So please forgive me. But I'm just going to wait for it to load up. So if I just search for the term Tesla, right? So that's your standard stock trading in US dollars on the NASDAQ exchange. A company called Granite Shares is offering me three times long Tesla, i.e., three times the performance of Tesla, and minus three times short Tesla. So, this will make money if Tesla goes down. And then you got minus 1x from a different company called Leveraged Shares, apparently. And minus 1x, minus 2x, and then 2x, and then 3x itself. That is the actual Tesla stock being traded on the Dutch exchange. You can have a stock being traded on different exchanges, which is something I'm not going to cover, but that's something that's entirely possible. But the rest of them, as you can see, are traded in the London Stock Exchange. And the reason that why there are so many 1x, 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 or minus 1x rather, is because this is in euros, this is in pence or pounds, and this is in dollars. So you can pick the one that suits your currency or your account's currency best, because there will be a conversion fee involved from the broker's side. Don't be fooled by the misproportion sizing of the price of the stock. So if this is like 0.00670 and that's 670, it doesn't mean that this can go to zero. If this goes to zero, it means Tesla has gone to infinite price, literally infinite. So just because if Tesla moves down 50%, this will actually double in value. And likewise, if Tesla goes, oh sorry, this will go, this will, if Tesla moves up 50%, this would be about 1.5 times in value of whatever it is. And if Tesla goes down, goes up 50%, then this would be minus 3 times half, which is sorry, minus 3 times. Well, let's go 100% because I really can't do math. I'm terrible at this. Sorry. Um, yeah, if Tesla moves down 10%, for example, then this would be up 30%. So think about it in absolute percentage form rather than absolute numbers. I mean, this can only go to zero when Tesla goes to infinity, which is not going to happen. Nothing can actually reach infinity. It'll asymptote to 9 billion or 9 quintillion for all we know. In which case that would be very very close to 0.00001 or whatever, if that makes sense. So you can roughly see that happening here. So Tesla is up 5% on the day, and this has been down 16%. And Tesla's and the converse share, which is 3 times long, is actually up 17%. So they will try to mimic what they say on the tin, and that's the easiest form of leverage most retail investors can obtain in their accounts, so to speak. Right. Having moved on from there, hopefully that made sense. I'm sorry for the mix-up, but it can get quite confusing, talking about minus 3x and 3x kind of stuff. Let's crack on. Leverage ETFs. We can now move on to, oops, sorry. Okay, just deal with my Windows bar being there. Sorry about that. We finally have contracts for differences. I do hate contracts for differences or CFDs with a passion. I think they're so bad that America had to ban them, and we all know America is a breakneck capitalistic society. So something's not right here. So a contract for difference, or CFD, is a contract you open or close with your broker that pays the difference in the settlement price between the period in which the contract was opened and then consequently closed, right? So if Tesla moves up 10%, you will open a contract, put some collateral down, open a contract, and Tesla moves move up 10%, you will make a profit that is shared between yourself and the broker, or whoever's underwriting the contract for you, your counterparty who's taking the other side of the trade. You will share the profits or the losses with them to an extent. With CFDs, my understanding is that the market or people who are your counterparties are usually your broker itself, and they're the ones charging the fees and running the show behind the screen. This is my understanding. I may be completely wrong, but that's what I think. It's great for ultra short periods of time, intraday or few days at most, to speculate on the price of the underlying rising or falling. So you have to be directional to be able to profit off of CFDs. Neutral plays or time delayed plays do not work in your favor. So the longer it takes, or the longer the play is in action, and the more and if it's not working in your favor, even if it's neutral, if Tesla just hovers at the price, you're going to be losing money just because of fees and interest rates. CFDs are almost always cash settled, so there's no physical settlement. You don't have any right on the underlying. So Tesla shares are not touched. You have no right on the shares themselves. It's purely a contract. And the leverage that's provided to you ranges for products and brokers, depending on what they choose for you. It could be anywhere between 2 times and 500 times. So 2 times would be something for that's very volatile, something like Tesla stock, for example. Most stocks that have a CFD version would be lowly leveraged, whereas something that moves very little, for example, bond prices or even crude oil prices, they would be high leverage, so you can profit, or you have the potential to profit off of small moves. So again, let's put it into action while we're at it. Let's go to my dummy CFD account, YOLO. I've got 50 grand to play with thanks to Trading 212, not real money, of course. Let's look at crude oil, right? So that's the crude oil. I've got Tesla open as well, but let's look at crude oil first. So I've got a buy button. I've got a sell button, which means I will sell to open a position, and then I've got a buy button that's buy to open a position again. These are contracts based on that, and then here you go. You can that's the number of that's the leverage, or that's the number of shares you can actually trade, or that trading 212 is allowing me to trade based on my account size and margin. Margin is that much, that's how much of the collateral you will need to put up in cash. So if you're trading like $1,000 account, I think $1,000 uh, notional value, not quantity, $1,000 notional value, then you have to put up 0.33% as collateral. And leverage is 1 to 300%. I think they're both the inverse of each other. So for every 1 point move in difference, not total move, but the difference since you opened the contract will result in a 300-point change in your profit or loss account. And again, this is your overnight interest. So as I said, these will charge you fees. That's how much interest they will charge you for holding the position overnight. And the overnight time is given at 10 p.m. UK time. So at 10 p.m., this interest will be charged to your account as a fee. So you will be down by that percentage, for holding the position over several days. Every day that interest is going to deduct from your account, so to speak. And that's your opposite long side if you want to hold it. So again, for Tesla, which is a very volatile stock, you see 5% moves in a day. Again, you've got that's how many shares I can trade with, because the Tesla notional value, each share is $600 versus just, so it's about 10 times larger. The leverage I have with Tesla is a little less, 1 to 2, because it's so volatile. And also it only allows me to trade 400 units of trading to do. I think margin 50% is how much collateral I have to put off the notional value being placed, and that's your interest being charged on an overnight position, and that's the time that the interest is being applied at. Bottom here is when the market's open. You can see it's almost like 23/7. No, 9 hours a day less. So about what 13 hours a day, I think. Oh, 8 hours a day less. So about 12 hours. No, 16 hours a day. Sorry, that's when the market's open. 16 hours a day, 5 days a week. So let's open a position in Tesla and see what's up. I mean, it's not my money anyway, so I don't really care. I can click on new market order here, and I can either sell to short Tesla, or buy to be long Tesla. You see, it's moving around there. So let's go sell. I can trade 20 shares with the Tesla, and my margin would be 4,800 pounds in this particular case. There you go. So that's amount margins. I don't know what swap means. I've never traded CFDs, so I don't exactly know what is going on here. But let's show Tesla and see what happens. So let's confirm the sell, and now I've sold to open a position. That's my price, and I will make a profit on the diff or loss based on the difference of this price versus this price multiplied by the number of shares that I've traded. And I'm already seven quid down. And conversely, because I've got money in my account, so blocked funds 4,800, which is the margin that's used up, because I got money in my account, I can actually go and trade more shares. So let's go here in Tesla, and let's buy that many shares. So let's buy an equal number of shares. It's 20 over there. Sorry if I'm going too quickly through this. I just want to try to cover a lot today, really. uh, I'm waiting for it to refresh, really. So, oh wait, there you go. So now I've actually longed those shares, and that's the amount of margin I've used up. Yep. So there you go. That's what it's. So if I want to close these positions, I think I've had enough risk for a day. I can just close my. That what I just did was a sell to close, and because this is a sell position, I can buy to close that position back, and I've made a loss of like 15 quid over the 2 minutes that this just happened. Right. Ooh, that's a lot. Let's move on to options. So I'm just going to quit this and then try again. So from current slide. Right, my Windows bar is now permanently stuck there. Deal with it. Options are my personal favorite form of leverage or derivative, because they're much more mathematical based than just a 50-50 chance compared to CFDs or other things out there. Just ignore what's in the bracket at first. That makes life a lot easier. So a buyer of the contract, of an option contract, pays a premium, which is basically a fee upfront, to have the right but not the obligation to buy the underlying asset at a predetermined price and predetermined date. So time will work against an option buyer, right? And of course, asset price. So if asset price would also work either for them or against them, depending on what we're going to discuss in a minute. Conversely, a seller of the contract receives the premium. They're the other side of the trade, uh, to have the right but not the obligation to sell the underlying asset at a predetermined price and date, right? And that's what the other side of the party is. And you've got two choices: calls and puts. So a buyer of a call would bet that is betting that the stock goes up, and a buyer of a put is hoping or betting the stock goes down. They're opposites. Likewise, a seller of a call is hoping the stock goes down, so you're actually synthetically short, and a buyer of a call would be synthetically long. Again, a seller of a put is hoping that the stock goes up. You're synthetically long. So they're conversely opposite positions, if you can understand what's happening here, right? So there a buyer would then say that so options expire on Fridays, right? So a buyer would say that by Friday Tesla will close at about 600 something, and if it does that, he has a right to buy Tesla at 600. It's 650 right now. Let's say it's 700. Let's say he buys a 700 call. The buyer is betting that, or is hoping, or is paying the premium to have the right to buy Tesla at $700 by Friday. um, so if Tesla goes to 705 on Friday, he can buy that he can then buy those shares at 700 and then sell them in the market, profiting $5 per share that's in the contract. So stock option contracts are typically standardized to 100 shares of the underlying. So it's by default 100 times leverage. Likewise, the seller who sold him that call option has to sell the 100 shares of Tesla to the buyer at 700, regardless of the price that the market is saying. So obviously, if Tesla closes at 690, then the buyer will not exercise the option, right? And they will just buy it from the market, because they're saving $10 by buying it from the market, as opposed to the call contract that they bought instead. They typically come in two flavors. American options can be exercised, as in the contract can be exercised, meaning that it can be acted upon at any time before the expiration. So if Tesla hits 1,000 on my 700 call, I can exercise tomorrow, which is a Thursday, or I could exercise a month before if I want to. And then you've got European options, which can only be exercised at expiration if you want to do that. You can, of course, choose not to do it, but it's entirely up to you. And that's the two type of options that are out there available to people. Futures are basically, in my opinion, in my understanding, they're just options without the option. So likewise, a buyer of the contract is legally obligated to buy the underlying asset at a predetermined price and date in the future. And likewise, a seller is obligated to sell the underlying asset at a predetermined price and date in the future. So there's no premium exchanging hands here. It's literally a hard contract that comes into play. So all contracts state a standardized quality and quantity. Quality being, if it's crude oil, what kind of crude oil is it? What's the amount of sulfates in it and stuff like that? Likewise with cattle or gold, what purity? Silver, what purity? That kind of thing. And the quantity, it could be in tons, it could be in pounds, which is weight pounds. It could be in barrels, so on and so forth. And it can be settled physically. Oops. Or it can be settled in cash, as in you pay your difference again back to your broker. Uh, Originally, it was created so that farmers or people who are in the business of volatile commodities can get a guaranteed price for their item in the future. So if oil right now is so fluctuating, I will sell a future contract for $60, and whoever buys that has to buy my barrels of oil at $60, regardless of what the price is in the future. 6 months, 1 year from now. If the price is above $60, then I've basically made a loss. Whereas if the price is below $60, I've made a profit because I can sell at 60, for example. And this used to happen for oil, grains, cattle, now even water, to be honest. And that's a real thing, actually, that's happening out there. Finally, the most elusive of them all is swaps. Swaps are a contract where two parties exchange, or basically swap, their cash flow or liabilities from two different financial instruments for a given period of time. It's basically it's been made famous by the movie The Big Short. And what Michael Burry, who is I think Christian Bale in that movie, and the other gang, the protagonists in that movie, is they bought swap options on mortgage backed securities. Mortgage backed securities, basically, if 10 people with excellent credit scores get a mortgage, their mortgage could be summed into a single stock and sold to a different party. It would be a low rate, high chance of probability, but low reward scenario. And likewise, if you take some poor credit scores, you could actually wrap them up into a poor credit score mortgages who are likely to default. You could wrap them up into a security, a stock, so to speak, and sell it to other people as a contract. So what Michael Burry did is he bought credit default swaps, which is if this particular stock full of mortgages defaults on their mortgage, then I want the difference in the default rate, so to speak. So that's how he made his money in there. But it can be used to reduce cost of businesses if they swap interest rates. So a good credit score company could swap their loan interest rate with a bad credit score company for a particular fee that the bad credit score company would pay the good credit score company. This would then mean for the poor credit score company, this would mean that they would pay a lower interest rate on their loan, and for the good credit score company, this would mean that they could get another loan at a different variable and possibly a lower rate. Hence, why they would do the swap, and they would also, of course, they might even receive cash for doing the swap as a sweet thing out there, like as a sweetener to the deal. Sadly, it's not available to retail investors and requires some special intermediaries, which are like big banks, to facilitate this kind of thing. So the same hedge fund that went defunct a few days ago, they probably use swaps as well that were in place with banks like Goldman Sachs or Credit Suisse or Nomura, which is a big Japanese bank, and I think Morgan Stanley was the fourth one. I don't know. But yeah, you do require large capital to play around with these. Right. Sorry. So this has been like a stressful 35 minutes to get through all of this, so quickly. But I know there's a lot to take in this particular episode. But it's important you understand what these instruments are, even though you don't know. If you never use them in your life, it's fine. But it's important you understand how they work or a general idea, so that you can utilize them for the future if you need to. Lastly, that's just something Warren Buffett said. But I think with the right derivatives or the right amount of leverage, if you know what you're doing, you could consistently go up in value if you go up in your capital, if you feel that's the way to go. Right. So, lastly, again, this is my basic reference list. Feel free to have a look at some of these things. They don't trade. There's not a lot about options or any of what we spoke about today. CFTs again are the most commonly accessible, but you can also look at leveraged ETFs if you want to, by all means. Yeah, I think it's important you go and explore these riskier options and see riskier choices or instruments and see what's out there, just to get an understanding and appreciation for what's available to us as retail investors, so to speak. And the world's your oyster for that kind of exploration. I know it's been again a lot that we went through. I wish I could have shown you stuff about options and CFDs further, because I think I had a few examples lined up, but sadly we are running out of time today, and today it's a heavy topic. So if you've got any questions that you think would be helpful to yourself, like CFDs or options or whatever, feel free to catch me in person, or message me on social, and I'm more than happy to try to explain the idea. I'm not going to tell you what to trade, obviously, but I'm more than happy to explain what's happening out there. So yeah, thank you once again for your time. Sorry it's been so hectic. Sorry I've rushed through several things, and if I confuse you with leverage ETFs, I hope this slide sums up what's happening out there. Same with CFDs. I've never traded them, so my math on them would be a bit poor. How the profit and loss is calculated might be a bit poor, but I was trying to get the base idea across, so that you know what you're doing when it comes to CFDs, rather than just YOLOing your money on Tesla buys or Tesla long CFD options at 100 times leverage, so to speak. Oh, one thing I forgot to mention is trading 212 does allow you to select the sort of number of shares you want to trade as well. So that's another form of leverage. So crude oil would be 1,500 units or barrels. I don't know what units there are here, but you can change for most brokers. You can change the amount of leverage you take on, and for stocks specifically, if you're not feeling too courageous about leverage, then by all means just go and buy a single unit or a single digit number of stocks just to play around with if you feel like it. But yeah, that's how it is. And yeah, that's all I want to put across today. Hopefully, again, if you've got any questions, please put them in chat or feel free to find me in person. Brilliant. Thank you so much for your time. And yeah, see you all around. Ooh.